Hi, today we are going to use our investment checklist to see if Cathie Wu's top 10 holdings in her flagship ARK Innovation ETF are golden gems or turds. Well, first let's look at what they are in case you don't know. So they are Tesla, Datadog, Roku, Zoom, Coinbase, Exact Sciences, Unity Software, Intellia Therapeutics, Twilio, and UiPath. So very quickly you can find it hasn't been a very good year for Cathie. So last 3 months and last 1 year, most of the stocks she owns in the top 10 holdings are down, and actually only Tesla is going up on a 1 year basis. So up 20% on 1 year. Some of the other stocks are really beaten down. So Datadog down 70, Roku down 70, Zoom down 70. So remember, these are all the stocks that benefit from the pandemic when people move from physical world to online. The likes of Zoom, Unity, Roku, Datadog, they are all benefiting from that megatrend. But however, when people start to talk about megatrend, you see the opposite, ironically. So last 1 year is definitely a pretty tough year performance-wise for Cathie. And the second thing you can see here is actually only Tesla is doing well. And despite being about 8-9% of the fund, which definitely helped on that front, but the rest are dragging performances. And the third thing to find out here is the top 10 holdings are highly concentration stocks. So all of them adding up together, they are about 60-70% of the ETF. So it's definitely something that Cathie believes in, which is to invest in highly concentrated portfolios. And if she's right, she's really right. However, if she's wrong in some unfortunate cases, it can be really bad. And now let's quickly move on to the performance comparison against the US market and also the global markets. So that gives you a better picture of both short-term and long-term performances. So as you can see here, last 3 months down 33, 1 year down 24. Again, this is not the ETF performance because we're just looking at the top 10 holdings here. However, if you look at the last 3 year, 5 year, and 10 years, most of these stocks are doing fantastically well. So last 10 year, for example, it has returned 1,860% versus the global markets of only 160% for the last 10 years. That is really impressive outperformance. And if you drill down into what is the contribution of performances by each of them, you can simply tap into this link and you can see all the breakdowns. And let's just quickly go to 10 year for now to see what is the long-term performances. So on a 10-year basis, Tesla without a doubt is the biggest winner. Well, it's returned 11,000%, 12,000% almost. And then Exact Sciences, that's another big winner over the long term. But actually, what's interesting is a lot of these companies, they don't exist 10 years ago. So that echoes another point by Cathie. That is, if you are buying the winners for tomorrow, a lot of the winners in 10 years' time would not have existed 10 years ago. So that's one of her philosophies of looking for new winners. And if she's right, once again, she can be really right. For example, on Tesla, she's definitely a key advocate, and she started to buy Tesla 5-10 years ago, and this has definitely benefited that. And the next interesting thing is to look at the sector exposure of these top 10 holdings, which again can give you a bit of sense of how Cathie invests and what her investment style is in general. So top 10 holdings, if you look at the sector breakdown, without a doubt, something that she always believed in, information technology, innovation companies. So that is 35%. And surprisingly, healthcare, which is another theme that she has been talking about, but she only started to add to a lot of the healthcare names in the last 2-3 years. That is now 29% of these top 10 holdings. So that is Datadog, Exact Sciences, and Intellia Therapeutics. Those are the 3 key holdings there. Consumer discretionary, which is again very closely related to consumption trends, big innovation. Communication services, so that is Zoom in there, and then financials. So Coinbase is one example. So what's interesting is that she is not investing in all the other 7 or 8 sectors. So there are about 11 sectors. So she doesn't invest in any real estate, in a big way, at least in the top 10. She doesn't invest in any energy. She doesn't invest in any materials. So utilities, industrials. So it's very interesting that a lot of the companies she just ignores to start with. And that's very important, especially when you think about how you can maintain your own unique and distinctive investment style. You just don't invest in a lot of the companies to begin with, because you only follow the companies in your investment universe. And in this case, she only invests in innovation companies. That's why a lot of these sectors are where you can find a lot of the innovation ideas. And now let's move on to using the watch list to see on a very high level our investment checklist. What is top, what is neutral, and what is fail. So this is a very simple view. You can see most of these companies have at least some greens there. So that is the top, and by top we mean that factor is ranking in the top 20% of the entire universe. However, it's a bit worrying that a lot of the companies are having a reasonable number of flags there, so fails there. So for example, Coinbase is only 5 top, 1 neutral, 5 fail. That is okay-ish. But however, if you scroll down to a lot of the other companies, they are mostly somewhere in the neutral. So Exact Sciences, for example, it's only 2 tops, 8 neutrals, and then 2 fails. So a lot of the factors here are not working in her favor, and it's a little bit worrying. You can see quite a lot of red here. So from Coinbase to Twilio, for example, 3 fails. UiPath, 3 fails. So we'll dig into each one of them later to see what is going on there. But on a high-level snapshot, this is deserving some attention. This is not a portfolio that you would expect from a highly successful fund manager, because quite a lot of fails are showing up. And the other way to look at this is if you switch into the ranking view, you can see for the 3 main factors we rank, from quality, value to momentum, where does each stock stand. So Tesla, for example, is looking pretty good there. So quality in the top 20%, hence the gold laurel around. Momentum, that is a bit of surprise there. In the top 20%, actually very strong at number 104 out of all the close to 8,000 companies we rank. But you're not seeing a lot of other gold laurels there. So Exact Sciences, there's none. Intel, there's none. Roku, only 1. Teladoc, only 1. So you began to see where the problems may arise, which is she's not really investing in quality and momentum. And a lot of, or if not all, of her companies are very expensive on valuation. And now if we group all of them into one portfolio and to see if the checklist of this portfolio is giving us any important information. So as you can see here, only 2 out of 13 factors are scoring top, which is the top 20%, 8 neutrals and 2 fails. So on a nutshell, it's not really a portfolio you would expect from a really high conviction fund manager, because at least for some of the key factors such as quality, value, or momentum, it has to tick some of them. And as you can see here, it's a bit worrying that her valuation is in the fail bucket. So that tells you she's investing a lot of companies that are very expensive on some conventional price multiples, such as price to earnings, free cash flow, dividend yield. So it's not a cheap portfolio to invest in for sure. However, if you look at share price stability, it's another concern for you. When you look at why you invest in a long-term investment horizon ETF, you want the ETF to be stable. It just gives you some decent returns every year, but not big ups and not big downs. Because a lot of people buy ETFs for retirement purpose. They are not buying ETF for some short-term trading. If you do want to do short-term trading, you buy individual stocks. So in this case, 2 of the key long-term positive return indicators are not showing you a rosy picture. Valuation, very expensive. Stability, very low. And now if we scroll down, we can see some of the key financial metrics. So quality high, you can see 0% dividend payout. So none of her companies are paying any dividends at all. So that is a red flag. Value, very expensive, not surprisingly. It's a whopping 107 times forward PE for our top 10 holdings on average, which is a very, very punchy view to take. If you want to bet on some companies, you have to believe that these companies in 3 or 5 year time, the earnings will catch up. Otherwise, if this portfolio all of a sudden halves in value, it's still trading on 80 times PE, which is still very, very expensive. 0.3% free cash flow yield. So a lot of these companies are just on the verge of making positive free cash flow. Again, they are, if you look at these numbers, it tells you that she may be early in some of her investments because they still need to grow earnings, they still need to generate cash flow, and if they don't, in the unfortunate event, things will go the other way very quickly and very badly. Now, the other worrying sign is that a lot of the companies, if you want to invest in long-term winners, you have to have companies that consistently beat market expectations. So that is, if the company does better than what you think or what the market in general has expected, it's very likely that the share price will go up. So the more positive surprises, the better. Whereas in this case, you are having a mixed picture. So you have 4% revenue revisions in the last 3 months, but you're having negative 27% downward revisions on earnings. So that is a bit worrying to see there. You want companies that can beat on both revenue as well as on earnings. And lastly, we can go into the detailed breakdown view, and you can see, quality, some of the key metrics, and by each of the stocks. So Tesla is doing very well, 30% ROE. However, if you look at Datadog, it's actually negative ROE, so meaning the company is loss-making. Exact Sciences, negative ROE. Unity Software, negative ROE. So these are the top 10 holdings, and you don't want to invest in top 10 holdings unless you really believe that these ROEs will become positive. And again, she may be right, she may be wrong. She has been right in most of the cases. But if you look at the last 3 years, a lot of the companies she invested in may be quite early. So they're still before making money, still loss-making. So it's one area definitely to keep an eye on. And then switch to value. You can see here, without a doubt, this is something that she always says. I invest in a lot of the seemingly expensive companies, but in the long term, they will catch up on their earnings. But for now, at least for the next 12 months, this is their forward PEs. So a lot of expensive companies you can see here. So Coinbase, 67 times PE, Zoom, 36. And a lot of companies are, because they're loss-making, so they don't really have a PE ratio. So Datadog, Roku, Exact Sciences, Unity Software, Intelia, and Twilio. So a lot of them are loss-making. So once again, very punchy view she's taking on these companies, turning around their P&L and be able to generate positive earnings and positive free cash flow in the future. So in summary, what we can learn, I think there are 3 key takeaways. The first takeaway is it's a very highly concentrated portfolio. So top 10 holdings are about 60-70%, depending on what days you look at. She always buys and sells very frequently, but it's a very highly concentrated portfolio. So for a typical fund manager, that is the right way to do, because if you're actively picking stocks, you want to bet on high conviction companies, but when it works really well, and when it doesn't, it will hurt your performances really badly. So that's point number 1 to take away. Remember, this is not your daily buy and hold, long-term horizon, low volatility investment portfolio. This is actually a highly concentrated, highly volatile ETF. Point number 2, it's a combination of very expensive valuation and low momentum. So that is something to bear in mind. You are not really buying into some dividend-paying steady companies that just grow earnings 10%, 12% a year. You're actually buying a very early stage, almost a startup portfolio. A lot of the companies are pretty small in market capitalization. So you're buying a very expensive and low momentum portfolio at this point in time. And number 3, last point, it's a highly volatile portfolio. So once again, if you look at the volatility rank, it's in the low 20%. So this is a very volatile portfolio. So if you want to invest with your retirement money and you want to have a long-term view and just want to buy and hold and being risk averse and collecting dividends, this is definitely not your portfolio to look at, because it's so volatile, it's so highly concentrated, and a lot of the companies are still loss-making at this stage. However, having said that, to end this on a positive note, if you are bullish on the ability for individual fund managers to pick long-term winners, and if you're bullish on innovations and you believe that Cathie Wood is the right person to pick innovation ideas on our behalf, and if you're bullish on the markets in general, because in the US the markets are driven by growth and Cathie invests in a lot of the growth oriented areas of the markets. So if you are all of these people, this will be a fund that deserves a lot of your attention, because it is one of the largest out there, it is the most liquid out there, and Cathie is the most outspoken and well-reputed fund manager so far to date. Hope you enjoy it. Any comments, let us know. See you next time.